Thank you very much, Daniel. Right, let's talk about bankers. So with that theme in mind, I'm going to try and touch a little bit on what bankers does, how we invest, so how I invest assets within the trust and try and draw out some conclusions for you there. I'll also touch on some aspects, I think, broadly about investment trusts that I think are important to look at and review and judge again, and we'll set out how bankers sits against those. And I'll also wrap up with a little view of where I see some of the market positioning. So where do we start? So Bankers is an old trust. It goes back to 1888. It was launched, and still very lucky. I've got the original annual accounts, not the actual original accounts, but this was something we photocopied the originals from 1889, the first year. And so, the history of it is quite fascinating, really. It was launched for clients of a bank called Glyn Mills, which some of you may remember or even have a grasp about. It's currently in NatWest. Bank bought it up in the, I think, the 70s. So it was invested, really, the idea was to give access to their clients, smaller investors, access to global markets, to global investments. And really, we carried that on. And you'll see later, we continue to do that. It was quite racy in its early days. It was sort of had gearing of 50%. So every pound they took in, they borrowed another 50 pence of debt. So it was quite leveraged, as it were, but very wide. So 240 investments, mainly debt, mainly preferred stock, as it's called. So bonds, effectively. Some equity, some great names that are still around today. Hong Kong and Shanghai Bank. So HSBC we've owned continuously since 1888. Distillers is in there, which is effectively what Diageo is these days. But essentially railroads, banks, utilities, sort of funding the new world, expansion of the new world, really, I suppose. Some wonderful old names. Lee Biggs Extractive Meat Company, which is always one of my favourites, which is basically Argentinian beef sort of coming over to Europe. Fray Bentos pies, believe it or not, was what they used to own in Bovril. So quite a nice history there. And then through the sort of into pre-war and into post-war, moved from bonds to equities as equities sort of became more prevalent as an investment, I suppose. And then in the 1950s, a lot of exchange controls post-war, problems holding international assets, and the trust went very domestic, very UK. So into really the 60s and 70s, almost 95% UK holdings. And then in the 70s and 80s, we expanded back out again internationally, starting with Japan. And then 4 years ago, we started our first holdings of domestic Chinese investments, so onshore Chinese A shares. Just some seats there for them. So quite an interesting history, really. Where are we today? So back to the sort of simple language, really, bankers today is an objective there to provide capital and income growth from global equities. So quite a simple remit, and literally what it was designed to do right at the beginning, so give smaller investors access to global markets. We're over £1 billion now. It's 3 million launched, so over £1 billion of assets now. Quoted on the London stock market, but also in New Zealand. Probably not enough time to go through that, but 15% of our investors are based in New Zealand as well. And we have a value investment style, so I'm going to touch on that in a minute and draw out the conclusions from that. Dividends on the right there, very much committed to growing income. So we have a commitment in the accounts there to grow our dividends above RPI. So RPI, the retail price inflation indicator there in the UK. And you can see the black line is us, almost doubling dividends in 10 years, and RPI is up about 30%. So we've got a good track record there, and I'll touch on that as well. So how do we run the fund? So I took over the fund in 2003, so I've been on Bankers now for 16 years. I used to run the UK section. I've also run emerging markets there, brief time in Japan. So I've touched on a lot of the portfolios. Today I do what's called asset allocation. So my job is to get the investments into the right markets where we think we're going to maximize returns. So how much do we put in the UK? How much do we put in America, etc.? That's my core role really these days. And then I have specialist managers sitting there running discrete portfolios. So that gives us a lot more holdings than a normal trust, really. We're roughly just under 200 there on the right. But I like to think about each sort of sub-portfolio is running around about 20 holdings, roughly. So that gives it a reasonable amount of sort of active exposure. We're not picking all the large holdings in Japan or North America. We're really trying to cherry pick the best opportunities in there. But when you blend all that together to something just under 200, you have a much sort of, I think, a more steady, more consistent ride through markets. You can see all the managers really 20 years plus experience. So I'm really trying to have the best. That Janice Henderson, who sit and manage the fund, really on each of those portfolios. So that's sort of how the trust is structured, I suppose. Let's talk about investment style then. How do we invest? What are we looking for when we're picking those stocks that Daniel was talking about earlier? And to me, I start with the importance of dividends. I'm a big believer on income, on dividends as really the core of where you start. And some lovely quotes here. Rockefeller, I don't think, ever really got out much, but to him, the pleasure, his only pleasure really, I think, was seeing his cash grow and his dividends come in. But again, a lovely one from Jane Austen, then one of her books, Large Income is the Best Recipe for Happiness. So again, income to me, I think, is really important. The sort of grandfather of value investing, if you've gone and Googled this guy, I think he's the Bible he wrote, really drives a lot of us. But the prime purpose, he said there, of a business corporation is to pay dividends to its owners. And then, one of the largest companies in the UK, Scottish and Southern, again, the chairman here a few years ago now, actually talking about how the business is designed not to sacrifice investment, to drive investment and returns that will then fund dividends to investors. So I'm a big believer in dividends as a core part of the returns we generate. And I think why that works is, you look at a lot of long-term studies and it will show you that higher yielding, so above average yielding stocks generally outperform over long periods, so through cycles this is. And the key really, the research we've done is not just picking the highest yielding. There is a function as the price falls or people worry about the dividends. We're talking about Vodafone. When stocks are in trouble, the yield will go up. If you just buy those, you're going to have a struggling, difficult portfolio. The key is growing dividends. So it's trying to marry an above average yield with dividends that are going to grow with you over time. And I think what's important there is the financial discipline it puts on managers, on people running those businesses. So they're focused here on the cash that a business generates, because you're writing a check to your shareholders, you're paying a dividend out. If you just go and borrow that from the bank, we can see that's not long-term and sustainable. So it focuses management, I think, on cash. It focuses them on maintaining a strong balance sheet. So again, supporting the business over the long term. And then critically, again, the capital discipline. So if they're issuing stock, if they're building the business, buying acquisitions, again, how are they going to generate the extra return to service those new shares? So I think financial discipline is important, and dividend growth on the right, if we get it right, generates more consistent returns, grows cash flow, again, to feed those dividends. So the obvious question is, how do you identify these? And to us, it's really about free cash yields, free cash flow yields, rather. And I'm trying not to get too technical in here. Essentially, just think of a business. What we're trying to do is look at the business as it grows over the years. How much cash does it generate in a year? So you can look at the cash in the bank account on the balance sheet at the beginning of the year. How does that change over the year? And what does the company spend that cash on as it generates it? So you've got some simple things. You pay your bills, you pay your staff, you pay your interest, you pay your tax, and you pay a certain amount of maintenance capital expenditure. So how do you keep the lights on? And essentially, those are things that a company should spend year in, year out. So we can analyze that. We can use our knowledge and understand whether they're skimping on that capital, are they skipping a few bills they should be paying. So we can do a lot of work around there. But essentially, what you're left with is free cash flow. And the free cash there can be used for, growth capex, so putting a new factory somewhere, expanding your business. You can buy businesses, you can acquire things, you can pay down debt. So actually, as a shareholder, you get more value. And critically, you can grow your dividends. So I think by identifying companies with strong free cash generation and then looking at that as a percentage of the market cap, how much yield are you getting, that to us is how we identify long-term good businesses. And you can see here, this is some work done by one of the brokers, Société Générale, over, this is my lifetime of working in the city, I suppose, 29 years now, since 1990. And this free cash flow yield as an investment style trumps all others. So PE, low PE, good PE or good price to book, it's the best value investment style. There was another research out this last month from Citi, again driving this, that free cash flow yields are one of the best investment styles for a value investor. So, I think it works. So with that lens, where does it take us in the world? Well, here's the portfolio as we stand, where it's listed. So how is the portfolio invested in different markets? And you can see here about a third, 30% in North America, quite a big allocation to the UK, 24% there, Europe, Japan, emerging markets, Asia. But actually, to me, as you may well know, if you start looking at companies, just because you're listed in the UK doesn't really mean you are a UK business. And so what I tend to look for is the next step down, and we look at the revenue that companies generate. So this is the revenue that our investments, where are they getting their revenue? Where are they earning that revenue around the world, their sales? And you get a very different picture here. So suddenly the UK drops right down to nearly 10%. So it's telling you what we own in the UK is very international. So we're investing in big international companies that happen to be listed and located in London. The US stays roughly where it was, and we suddenly pick up a lot more emerging market. So I think my job, really, the lens of what I'm trying to look for in investments is where can I see growth? I do want to buy growing companies, growing cash flow. Hopefully they'll grow their dividends for me, but I don't want to overpay for that. So I'm trying to have some discipline in the assets we own. And we do find emerging markets, particularly China, a very interesting market over the long term where we can see some very interesting growth opportunities. We just choose to own those by buying sort of more established, developed companies. There's a bit less risk, therefore, in the way they operate. So that's really where the portfolio is broken down. A few things I think are important before I quickly run through an outlook. And I think what drives me when I'm looking at investments, but also I think you should be looking at when you're investing in funds, is about fees. It's pretty obvious. The less fees you incur, hopefully the more assets you've got invested and the returns should be higher. All the trusts, luckily, you're going to see today, have got very low fees relative to their peers and many other funds. Bankers basically has a tiered structure, roughly about 0.45% of assets as management fees. There are very little extra costs the trust incurs, so our ongoing charge, that's wrapping everything together, is about 0.5%. So again, low fees. For that, you're getting direct access to China, India, over 32 different equity markets. So again, it's a good way, low-risk way of getting, low-cost way of getting access to international markets. I think the other aspect that's important to understand is about gearing. So again, when you look at investment trusts, one distinction between them and open-ended, OICs, mutual funds, etc., is that we can borrow some money. And again, it's nothing scary. To me, gearing should be tactical. So you should be looking at, to me, it's a bit like a sailing boat there. It's about raising your sails when the wind is behind you in your favor. And if it's getting a bit stormy, you take those sails down. So that, to me, is how we operate within bankers' gearing. I won't overcomplicate the table there, but essentially we've got access to capital markets. We can borrow money over long periods at reasonably low rates. So again, we can therefore, it's not extreme. So bankers' maximum gearing is about 6%. So it's not a huge amount, but we can enhance returns a little bit by borrowing over the long term and investing in that way. So I think, again, tactical gearing is important to me, not structural. And then finally, the dividend records. The investment trusts have a unique nature about them that we can retain some money, some dividends in the good years and spend it and return it to investors in more challenging years. So bankers has got 52 years now of consecutive dividend growth. We've increased the dividend every year since 1966. Actually, in 1966, we held the dividend. The history goes back into the 1950s and earlier. So very long-term growth records here. Over that 50 years, the average is about 10% per annum growth. So again, the stat I love is that if you bought bankers in 1984, we're roughly returning your investment annually in dividends. The growth in terms of compounding of dividends is that much over long periods. So again, get saving early is the other aspect. So trusts have great long-term dividend records, and bankers has a very fine one there. Let's quickly just touch, I've got a few more minutes to finish up, on how we see the world. Lots of uncertainty. I've not changed this slide in over a year. Nothing's changed. Brexit, quantitative tightening, all these sort of US, trade tariffs, et cetera, worries about corporate profit growth, et cetera. I think this year we will see some resolution on these. So I think in terms of market uncertainty and worries from a lot of investors, we will see some certainty. We can then judge whether, the market is prepared for whatever Brexit may bring or whatever trade tariffs may bring. And world trade. So I think at least in terms of clarifying some of these issues and worries, we can begin to price them into markets. So I think a little bit of clarity coming. I still see the world in a simple sense. There's some risks out there. One is that trade wars, cause a big growth risk and a shock there. I think that's pretty low. I put a 10% outcome on that. I think equally we could either overheat. The US market is very strong at the moment. The US economy is very strong, and obviously the federal bank in Federal Reserve in America has been raising interest rates to try and cool that growth. So you could see an overheating going on. They haven't put rates up enough. Equally, you could see a slump that actually maybe they've overdone it. So again, I think those are two finely balanced. To me, I think we're going to sit in the middle with what we've called the Goldilocks scenario of just, a long cycle of modest returns. So, from this point of view, very difficult to grow. Productivity growth is not accelerating. But that's actually not a bad world to exist in on the whole. Probably a complicated graph, but all I'm trying to show you there, this is quantitative easing or tightening. Central banks have been dominating asset prices markets since 2008. And all this graph is showing you that blue line being above zero means for the last sort of 5-6 years, central banks have been buying back bonds at a furious rate, particularly the US and the ECB, the European Central Bank. So they've been trying to drive down the cost of long-term money to support businesses, to support savers. Well, not savers, it's been quite detrimental to savers, actually, sorry. But to support markets and companies, I suppose, to grow and keep employment high. So that's worked to some extent, but from this point onwards, I think as this blue line, it's sort of virtually round about zero there in 2019, is telling you that actually I think central banks are not going to be that driver of markets. It's going to be more about profitability, more about the outcome for companies. So I think central banks are less of a driver in markets. And what's that meaning to me is that you should see long-term bond rates rise, and that's quite important. I probably won't explain the one on the right, but on the left here, the dots here that you're seeing are 10-year government bond rate. So in Germany, it's virtually zero, 0.3% to borrow over 10 years. So you're getting roughly 2.5% to 3% return over a 10-year period holding a German 10-year bond. So virtually nothing. It's more of a store of value. In the US, though, is the one market where long-term bond yields are actually higher than the equity dividend yield. That's where we've been really since the 1940s or something. So for almost 50, 60 years, the long-term trend tended to be with government bonds trading at a higher level than equity bonds because there's no growth, whereas equity dividend yields tend to grow over time. So I think there's still an echo of the crisis, there's still an echo of worry. I think this will correct itself by probably equity yields falling, which means prices go up and these long-term bonds rise. So, I think it'll be interesting how we go from there. There's been a big debate about growth over value. And as I said, I'm a more value investor. I tend to sort of equate it to sort of worshipping in the value church. You can either sit right at the front of the altar and buy everything that's very low PE, low price to book, cash on the balance sheet. I'm a bit more towards the back. I'm looking for growth in dividends, growth in cash flow. But we've had almost sort of since the crisis, really growth performing phenomenally well. So that graph on the left is telling you that growth over value is outperformed by about 30%. But what's very interesting to me on the right, the red line, is basically the earnings, the relative earnings potential from these two areas. And yes, over the last 7 or 8 years, growth companies have grown their earnings much quicker. But for the last 12 months, it's been pretty flat. I think there's a bit of a sea change coming here. And meanwhile, growth had a very strong year in 17 and 16. So I think there's probably a bit of a switch back coming here towards value investing over the next couple of years, particularly as central banks are not driving things. Where do I see some value? Well, the mining sector is a great one here. We love acronyms, so BARF against FANG. FANG you might know as sort of Facebook and Amazon, Apple, and Netflix and Google. BARF is basically BHP, Anglos, Rios, so the miners, the big miners. And what's interesting to me when you look at these miners, when I said about free cash flow yields, actually the grey lines are the mining stocks. You're getting a free cash flow yield of 11%. This means basically these companies, miners, could buy back 11% of their market cap, their stock, every single year, and still run the business as they currently are. Now they won't do that. They'll probably pay down some debt. They'll probably open some new mines. But we need a lot of copper. We need a lot of nickel, a lot of cobalt are in battery technologies. So I think the demand for a lot of their products is likely to continue to accelerate. And the market is putting them on very heavy discounts, certainly against some of these growth stocks. I actually own some of these growth names. So, Alphabet, Google we own in the portfolio, Amazon we own. So I'm not saying all of them, but actually I think the value now in miners looks very extreme and there's a good opportunity there. Finally, why the world isn't broken in my mind, high yield spread. So again, there's no signs of stress in markets in my mind, and particularly credit markets, bond yields. This is the best indicator. When I'm often asked what's the best indicator of recession coming, of times to really worry about market levels, to me it's this spread, so the differential between what companies are, higher risk companies are borrowing at from the banks and those 10-year long-term yields. You can see on the far right, it's risen a little bit, but it's no way the stress levels we had in 89, 90, big recession then obviously. 98, 99 was, more of a tech bubble, but also a recession in there. And then again, 2008, 9. So, I'm not seeing a lot of stress. I feel, it's down to what companies are driving. probably can't see this one from the back, but again, where are you positioned? Quickly, just wrapping up. So as I say, that we're not too worried about the economy, so we've still got some cyclical exposure. We're exposed to growth, particularly consumers. We think there's very low levels of unemployment, so very high levels of employment, a lot of wage growth coming through, both in the US and particularly in Asia and China. So we're looking at investments where consumers are going to spend money, and we find that interesting opportunity. I've been a bit cautious on the UK for the last 2 or 3 years, but we have started increasing UK a little bit, so domestic UK within that UK pot there. And then finally, if you look at the top 10 holdings we've got, there's one technology name there. I've been reducing my technology, but we still have some. So Microsoft is our largest holding. But look at the dividend growth there. Again, we're trying to prioritize businesses. They're going to give us double-digit dividend growth. So that really is, my time is up, I think. So that's a very quick canter through what the trust is, what Bankers does, and a few of the aspects I think which are important. Thank you very much. I'll hand over to our next speaker.
Thanks.